What are your thoughts on that? Are you thinking the same thing? Yeah,
It's
where are you
it's a very
at?
good point. I think the highest level of equity, on an average today is happening now, right?
Welcome to the Stephen Lee Thomas Show, where we provide expert advice for real estate entrepreneurs. And I'm your host, Stephen Lee Thomas. And it wasn't that long ago that I was navigating the challenges of real estate investing, learning from my mistakes, and building the business I have today. I created the show to give you simple, actionable, step-by-step strategies to help you do the same. Each week, we bring you in-depth discussions with industry leaders and professionals who share their knowledge and practical tips. So sit back, take notes, and let's dive into today's episode.
All right, everyone, welcome back to the show. Today we have Ruben Izgelov with us. And Ruben he's a real estate investor. He's grown his portfolio to over $500 million. That's a billion with a B. He's a co-founder of WeLend. It's a private lending company, and they provided over $250 million in funding to real estate investors. He's also the co-founder of States Capital Private Debt Fund, which has raised over $300 million to date. So we've got a powerhouse with us today. I'm super excited. Ruben, thank you so much for joining us today.
Steve, thank you so much for having me. It's a pleasure to be here.
Yeah, absolutely. Ruben, where are you calling in from, man?
New York, Queens, New York. To those of your listeners who are from Queens, who's on to you guys?
I'm not familiar with that. Go ahead and give me the background there, just so because I'm out in California, so I'm on like the
Yeah.
opposite end of the country from you. So, yeah, give us a
So
background.
you're in the other blue state.
Yes.
Yeah, but Queens is one of the five boroughs of New York City. I live in the suburbs of New York, you can say. When everyone thinks of New York City, they think of Manhattan, right? But there's a lot of outskirts to New York that is still kind of city type living with some pockets of the suburbs. So I'm in Queens, New York. Specifically, I live in Jamaica Estates, Fresh Meadows area,
Okay.
and then we have our office in Kew Gardens, New York, Queens, New York.
Nice, nice. Ruben, I was doing some research on you before the show. Um, you guys immigrated here and you have worked really hard to get where you're at. I would love to hear your story, your journey about, when you came and how you got to where you're at now.
Of course. So I appreciate you asking. So look, I mean, we immigrated to the U.S. in 1994. I was only about 6 years old. I may look like a lot older, but I'm only 38 years old. And at that time, my father came here with no English, no way of making money. He knew very few people because there was not too many of us from our community, from our home. Then here in New York, already established that can actually help. So there was very little kind of outlets and network of people that can actually get him to the next level of where he'd like to be. Came here with $750 and six mouths to feed. At times we lived in a one bedroom, one bathroom apartment with sometimes up to 15 people. Really, really humble beginnings, really, really tough times. Thankfully, I was only 10 years old. There was very little that I knew about what was happening until I hit that age of like, all right, I got to try to help and contribute. So, what I did at that time was start giving out flyers, right? I was a flyer boy in Queens, New York, on Queens Boulevard, Rego Park, Queens, for those of you who are familiar with it. Giving out flyers to people that were walking back past me. Kind of fast forward that little bit, started buying, selling, flipping, developing real estate throughout the New York area, specifically Queens, Brooklyn, and Bronx. But the way in which I got introduced to the real estate space is through my cousin, dear cousin, who was an Israeli guy, came here to America. You ever watch Zohan, that movie Zohan?
Yes,
The
yeah, yeah, yeah.
Zohar, yeah, it's a really cool movie. You should really watch it for those of you who haven't. It's like the epitome of who my cousin is. Really, really confident guy. Always felt like he knew what he was doing, but most of the time he did not. But nevertheless, he took me to his office one day and he said, "You know what? We're gonna go door knocking." So we went door knocking in Corona, Queens. At that time, this was 20 years ago, more. No, it was 25 years ago. Goodness, time flies. And it was a really, really bad neighborhood. It wasn't a place you wanted to be in, right? But he was door knocking to try to find properties that were physically, financially distressed to be
Hmm.
able to buy those properties at a discount, rehab them, and ultimately resell them. And his idea at that time was for me to actually go door knocking on his behalf. He would stand behind me, and ultimately he would kind of whoop in as soon as someone opened the door and kind of do his pitch because they see me, knocking on the door versus a 35-year-old at the time. So that really worked out well. I think one of the first three doors that I knocked on, one of those doors actually turned into a deal. And I was able to see the birth of a transaction from knocking on the door all the way down to the closing, all the way down to the rehab, and ultimately the resale. And for me, being able to kind of get the taste of real estate through that lens really had a lasting impact on me. Fast forward a little bit, I went to public education system, dropped out of high school, but then ultimately decided that education is important. So I ended up going back, got my GED, went to undergrad in St. John's, again, Queens, New York. I'm sure many of your listeners are probably going to be Googling Queens and learning more about it after this, but went to St. John's University and ultimately went to law school and graduated top of my class. And while doing all of that, I was buying, selling, flipping, developing real estate. And while buying, developing real estate, there's very little that you can do without the backing of some type of financier, right?
Right.
You have to have the ability to either raise capital through friends and family and be able to do so on every single transaction. You have to raise a large sums of money, especially in New York. Your average sale price, purchase price is, well over 800, 900,000. So you have to raise a lot of money. Or you can go the route of what we did, which was use a private hard money lender at the time, right? And this was a true Israeli guy, right, driving in his Mercedes, not the way in which we operate our private lending shop today, but this was more of an old school kind of guy who would go, door to door to see exactly what he was lending against, one man shop. And at that time, we were paying like almost 15% interest rate and like 4 points.
Wow.
But, we were able to see and get a glimpse into the private lending space and realize that, what, while he is not hitting the 30, 40, 50% returns on some of the deals that we were hitting, right? But he was in the most safest part of the capital stack, and he was earning his 20% coupon, passively sitting in his Mercedes driving door to door. And it was just like a light bulb went on, right? We realized that there is a really good place for us to be in, which is a private lending space, to be able to hit attractive equity-like return, double digits returns, while being in the safest part of the capital stack, meaning that we're the last ones into the deal, but we're the first ones out.
That is that's an amazing story. And I could like visualize it as you were going through there. So I can attest on the multifamily syndication side, and I have some coaching students, and I've got an online group. And ultimately, for myself, everyone I'm coaching, the people in my online community, 100% of the time, the bottleneck, the constraint, the limiting factor is, like you said, it's the capital. It's the capital. Like how do you
Yeah,
go up finding the capital for it?
yeah,
And then you get to this point where you're like you've reached out to your friends and family, and then well, they're kind of tapped out. So and then how do you close that gap, right? And so it's fascinating to hear your story, and I can totally relate to you on the capital raising side. So you made this shift over into private lending. And so we'll get there in a little bit, but so you were doing flips, right? You were
yeah.
primarily doing fix and flips. How did you I want to say, so you said a little bit about the realization of the capital was the safest side of it. Were there other factors that went into, I'm going to get away from the flips and get into the equity part? And
Oh, yeah.
yeah, can you elaborate on that a little bit?
Yeah. So, real estate is a tough business to be in, right? I think a lot of people have this misconception of, you go into real estate and you're going to hit, home runs on every single deal. While that is the case, most of the time, it's not always the case, right? And there are times where you really get your ass served to you, right? I mean, forgive me for being so candid here, but you might think that you're going into a deal and you have, a home run deal, you're projected to hit a $400,000 net profit, $500,000 net profit, and guess what? Two or three things that kind of shift to the left or to the right, into the wrong direction, that $400,000 or $500,000 profit is now in, a negative of 100,000, right? For example, what we see a lot of times, and this is a mistake that we see a lot of, inexperienced investors make, is they assume they're going to resell the property at X. Well, that resale, does not really, visualize or capture exactly what they were envisioning, right? Instead, they're selling it for $200,000 lower. And in addition to that, they're thinking that they're going to be able to renovate the property for Y. Well, guess what? That renovation goes over budget by another 150,000. And we're talking New York specifically, right? That's why the numbers are so high. And that $400,000 delta is really what turns the deal the other way around, right? So I think for us, we were doing at any time anywhere between like 50 to 100 transactions a year, buying, selling, flipping, developing, or wholesaling throughout New York. And we, it happens, right? When you go into a deal, you're thinking you're going to hit a home run, but it doesn't realize that way, right? So what I think kind of took us home with private lending is realizing that while on some of the deals we were buying, flipping, developing, and we were doing a lot of the work, going back and forth, midnight calls, what have you, the only lender, the only person rather that made money on that deal was the private lender, right? Versus us having to do all the work and still being, losing money on the deal. The only person that actually made money was our private hard money lender. So for us, it was an aha moment, right? We realized, okay, we can do this. We can try to put this together. And thankfully, a little after law school, I got called into this private lender conference. At that time, it was called the Pitbull Conference. Today, it's been rebranded to the National Private Lenders Association, which I actually sit on the committee on. I went into this conference because I wanted to find a cheaper source of liquidity for the deals that we were doing. We went in as private investors. We walked out as private lenders. I mean, we've never looked back since. And since then, we've originated about $700 million across about 1,400 loans, nationwide, while losing $0. If I would tell you that, on deals that we've purchased, if we had to purchase 1,400 properties, nationwide, deploying $700 million of equity, I think that, there would be a lot more losses than we have here. And I think the only reason why we don't actually see those losses as a private lender is because you're the first lien position collateralized by real estate and personally guaranteed by the borrowers.
Gotcha. My brain is definitely
It's a
thinking
lot
about
of
what you're thinking
information.
about. I was at an event a couple of weeks ago. So I'm strictly in the multifamily space syndication, but I went to a single family event. It was wholesaling and flipping. And I was like, what? I went, it was local. I was like, I'm not really gonna get much from it. But and I'd always dealt with the agency lenders, but then there was multiple private lenders there, and I was like, this is
Yeah, you
really
never know.
interesting. Yeah, there was
And not only that, I mean, listen, what I've learned, forgive me for
yeah,
interjecting, but what I've learned is that all these events, they're so helpful, right? I mean,
yeah.
that's one of the reasons why WeLend was born, right? Is by going on to this event, thinking that I'm going to find a cheaper source of for the deals, cheaper source of liquidity for the deals that we were doing. We went in thinking one thing, came out thinking a completely different thing, right?
Yeah.
We completely refocused and repositioned whatever our investment strategies were, whatever our views were on real estate, and the investments behind it. I think that's very important to be attending these events because you just never know what you get out of it.
Yeah, that is the same epiphany I had. It was like this was worth way more than number one what I'd hoped for, but by getting out of like my comfort zone a little bit to see a little bit different lens, it really opened my eyes a lot. So to go cross-pollinate and get these other ideas, then all of a sudden I'm like, oh, I have a little bit of an unfair advantage. And so I think it's, the people that are listening to this, yeah, don't be afraid to go into a networking event, one of these events. It's maybe not exactly what you're doing, but you're going to meet some great people. You're going to get some fresh perspectives, and
Totally.
it's totally going to help you grow a lot.
To your point, a lot of the private lenders who are, my competitors, but I also view them as my dear friends, who we learned a lot from, one another. Every single one of them was actually in our shoes, right? They were either developers, they were syndicators, they were really real estate operators before they were private lenders.
Hmm.
And I think having that keen insight into investing into real estate, knowing the walk and the shoes that your borrowers walk through every single day really helps you become a good private lender. And I think when we really decided to launch WeLend, I think we took all of that, as testimony to what we need to do as private lenders to make the life easier for a private investor who is operating in the industry and this world of real estate investing.
Well, let's use that to dig more into We Lend. Tell us exactly what it is, what the
Yeah.
product is, and how people can use that.
Totally. So we are private lenders. We lend to real estate investors and operators nationwide. Predominantly, where we focus right now is in the southeast of New York, New Jersey, Connecticut, Massachusetts. That's really kind of like our core
Hmm.
market. We provide short-term financing. When we say short-term, we only mean about 12 months
Okay.
financing for real estate operators to be able to buy physically financially distressed properties, reposition them through either, making sure that there's income producing tenants, doing some rehab to it, TLC to it, and ultimately either refinancing the property and keeping it in their portfolio, which we can help them with as well, or selling the property through a resale to an end user. I would say a good 60% of our borrowers today, they're buying properties with the intent of flipping. But 40% is with the intent of keeping. And that's really been kind of climbing upwards, right?
Really?
Whereas before, I think it was like almost 80-20 split. But nowadays, it's more of like a 60-40 split. And I see it kind of shifting into the different direction of where it's probably going to be 60-40 of holding, 40 selling, right? And the main reason to that is because, I mean, like, I don't mean to kind of try to foresee the future. I don't have any crystal ball. But I think with all these tariffs, which again, we're in April right now of 2025, with all these tariffs that are coming into play, it looks like inflation is inevitable, right? It's very possible that there's going to be a lot of cost overruns. Construction costs are going up. They're probably going to be going up by at least 30, 40%.
Hmm.
Not 40%, but probably about 30%. And as a result, that's going to trickle down to, the real estate values, right? Which means that ultimately, if I'm an operator, a real estate operator, and I just spent 30% more on my construction, when I'm reselling it, the property, I'm going to be putting that price right onto the next, user, right? To
Yeah,
the
yeah,
to
you
the to
have
the
to.
consumer. So I think that's really kind of why a lot of people are trying to hold on to the real estate because they see that the inflation is inching upwards, and it's really
Uh-huh,
the
uh-huh.
best way to hedge against what's to come.
Yeah, well, that's very interesting, um, to think about positioning yourself is to hold it because you're waiting for kind of the other shoe to drop there with is what it sounds like with
Oh
the
yeah.
inflation that's coming.
Oh yeah. Totally agree.
With your private lending, is it primarily single family, small multifamily, uh, 15 to 30 unit multifamily? Like,
Yeah.
where is that sweet spot for you guys?
We'll go down to as small as a single unit all the way up to about 40, 50 units. Also mixed use properties. So we do 1 to 4 multifamily and mixed use properties.
Okay.
I would say the bulk of our bread and butter right now, I want to say is between 1 to about 20 units.
Okay.
We like to kind of keep it there. Anything larger than that becomes really institutional. The borrowers are a little bit of a different grade,
Hmm.
especially when it comes down to New York, and they expect much different cost of capital that we just can't really service today, right?
Okay.
So as a result, what we're really focusing on is on 1 to 20 units because anything under 20 units, the borrower is a little bit smaller. They're a little bit smaller operator. Our cost of capital to them is a little bit more palpable, you can say. But to the guys that are greater than 20 units, they want the cheaper source of capital, the institutional capital they're able to get from other groups that we can't really compete with today.
Gotcha. So for the, my background, my area and expertise is really in the multifamily, in the you're mentioning that up to 20, 30 units. They're definitely the different buyer. And then when you start getting into the larger stuff, it like you said, it's much more institutional. And there's different lending climate there. A lot of the smaller buyers that I'm talking to these days, people are basically looking to level up a little bit from some of the single family stuff, maybe the duplexes are looking to get into something a little bit larger. What does what are the lending requirements that you guys have, and then what would the loan look like for those types of buyers?
Yeah. So look, we'll go up to 90% of the borrower's purchase price, 100% of their construction, and up to 75% of the property's after repair value, the
Okay.
ARV.
Okay.
Now, that's not to every borrower, right? And
Sure.
that's not on every single asset,
Hmm.
right?
Hmm.
That's predominantly to the experienced operators, the returning borrowers that work with us. We pride in the fact that we're also able to close deals within sometimes 24 to 36 hours, but on an average of about 7 to 10 business days. So it really pays dividends to be able to work with one lender versus having to deal with multiple lenders. And the reason why I
Right.
say that is because, you know, when you have a relationship with a lender and, you know, you as a lender know that they are committed to you, you're going to become committed to them, right? So as a result, there's some exceptions. Some deals have a little hair on it that, you know, other deals do not, that you need to make an exception on. And if you're a returning borrower who I know is committed to us, we are going to be committed to you, and we'll make those exceptions. We'll make things work for you because we know your track record. We've seen your execution in the past, and we know your commitment is with us.
That's awesome. And as far as the duration of the loan, you still in that 12-month window on those
Exactly.
20? Okay.
Exactly. And the main reason why is because most of our borrowers, they're buying properties, you know, with a bridge in mind when they're
Hmm.
using
Hmm.
us, right? So they're
Okay.
using us as short-term capital. As a result, you know, most of the borrowers that we're working with today, they reposition, resell, or refinance within 8 to 11 months. So 12 months is usually more than enough time.
Perfect. And then you mentioned you primarily working in the New York area. Do you do any private lending across the United States?
Totally, totally. I mean, we've done loans in states that I've never been into, right?
Okay.
Alabama as you know, one of them. Hawaii as another one, although I should be in Hawaii, but never been to Hawaii yet. So we lend, you know, nationwide. I think there's about 4 or 6 states that we don't lend in because of licensing requirements. But there's about 45, 46 states that we're lending actively in.
Awesome. Okay. And then just to confirm, you guys are the primary lender, right? Your first position on that, not second position, and that's with
Correct.
Wieland, correct?
Yes,
Okay.
exactly. So,
Okay.
you know, we are always the direct lender. You know, there's a lot of groups out there that are, you know, essentially brokers that deploy themselves as direct lenders. And the reason why is because a lot of direct lenders like ourselves are actually introducing white label programs where you're able to close in the client's or in the lender's name, but meanwhile, you're using someone else's capital. You know,
Hmm.
the good part about us is that we are a direct lender. We manage a 506c Reg D, friends and family money, and we're able to make deals and make decisions within, you know, 24 to 48 hours.
Awesome. Now you also have States Capital Private Debt Fund. How is that different than Wieland?
So Wheeland is the originator. States Capital is kind of where the friends and family sit. That's where the capital is to be able to fund the loans that Wheeland, the originator, brings in. That
Okay.
is our 506c Reg D. It's an exemption through the SEC. That's kind of where all the magic happens in terms of originating the loans and ultimately either pledging them over to our warehouse lines or selling them to the institutional secondary market backed by Wall Street.
If you're enjoying the podcast and want to fast track your way to becoming a full time real estate entrepreneur, then join the Multifamily Mastery Hub on School. You'll get access to our educational course library, live trainings, live interviews, and a community dedicated to helping you succeed. Visit school.com/multifamily mastery hub. That's SKOOL.com/multifamily mastery hub and fast track your way to becoming a full-time real estate entrepreneur today.
Okay. All right. Now with that, you mentioned this a little while ago. I want to know if you have any other predictions. Because that the conference I was just at was very interesting, and one of the speakers there was saying he's predicting the stock market's gonna tank here pretty quick. Similar to you, inflation's gonna go up. But here's something he mentioned. I'd like to get your thoughts on this. He said a lot of people have been sitting on their homes for a while and they have a lot of equity in them. If there's some type of recession and people need money, there might be lots of housing coming on the market because of that. People will just basically cash out with their homes. What are your thoughts on that? Are you thinking the same thing? Have you, yeah,
It's
where are you
it's a very
at?
good point. I think the highest level of equity, on an average today is happening now, right? Most of the homeowners today have the most amount of equity versus many years before, right? And
Hmm.
that's
Hmm.
mainly because of all the inflation that we've been battling with, right? Which I think is more to come. Borrowers have options. They don't have to sell, or owners have options, right? They don't have to sell their property to cash out their equity, right? It's a good point because I think what he's trying to say, or what he was trying to discuss, was more related to the supply and demand, right? The more supply we have, the lower the values are going to be and what have you. So what's that going to do to the market? I think, borrowers today in today's market, they have options to be able to refinance. There are non-QM products. There are bank statements products. There are DSCR products. There are, lenders out there, banks, right? Federally chartered, who will be able to lend to operators and owner occupants on properties up to 70% of the value, right? So
Hmm.
why have to sell a property when you can refinance and cash out the equity and use it through a warehouse line or some kind of facility? So I think, look, borrowers may have the option and they will choose to be able to sell, because then you still have to service that debt after. But I think most of the people are going to be holding on to their properties, cashing out their equity, and then repurposing that somewhere else.
Yeah, I can tell you, for example, like where we're at, the equity in our house hasn't quite doubled, and we've had it for like 6 years or something like that. And we were able to buy it when interest rates were pretty low, or refinanced pretty quickly because interest rates were lower, and it was just like the equities kind of went up and up and up. And I'm like, wow, there's a lot of equity here, and I didn't even have to do anything. So I'm one of those owners that has
I love it. I love it.
way more
The
equity than I
advantages,
was ever planning on. I was like, oh, this is pretty nice. So
yeah, the advantages
maybe
of owning real estate is unreal.
yes, yeah, maybe I'll use it as a checkbook kind of. We'll see. We'll cross that bridge when I get to it. But
Well, you
um,
know who to call.
yes, absolutely. Um, Ruben, where do you guys see yourself in the next 12 months and then in 5 years? What are your goals?
Yeah, it's a very good question. So look, I think one of the things that we're always obsessed about is our client, our borrower, and our investors, right? We have a lot of investors that have committed their hard-earned capital with us to be able to deploy that capital and hit, double-digit returns for them on a monthly basis with monthly returns. I think that is very important for us to be able to essentially kind of not only continue with their trust in us, but grow that trust.
Mhm.
But in order for that to happen, we need to be able to work with the right borrowers. We need to deploy the money into the right deals to the right people. And I think that's been a really big focus for us, is working with borrowers that we have great relationships with. Today, a good 70% of our deals are with returning borrowers, borrowers that we've already done deals with in the past. They've executed, they've paid off, and so on. And I think that for us is important, is to be able to put those two worlds together, to be able to hit the returns, consistent returns, double-digit returns to our investors who have trusted us with their hard-earned money, so that we can then ultimately trust our borrowers that we've worked with for so many years over and over and over with that same hard-earned capital.
So I want to hang out in this for just a moment because we were talking about your private lending, but you also provide the opportunity for people to invest with you into your private fund. Is that right?
Exactly.
What does
Exactly.
that look like if someone wanted to
Yeah.
invest with you guys?
So we, like I mentioned before, manage a 506c Reg D. It's an exemption through the SEC. It's a private debt fund. We're not buying real estate with it. We're lending on real estate. These are all first lien positions, collateralized, personally guaranteed by the borrowers. And we were proud to say that while we've deployed $700 million across about 1,400 loans, we've never lost principal. We've never lost a dime. And I think for me, that's very important, because today, majority of the money that we're managing is friends and family. I never want to have to face someone and tell them, hey, we lost some money.
Hmm.
And in real estate, that happens, right? And the reason why it happens is for a number of different reasons. For example, cost overruns, resale values, tenants not leaving in time, right? Just a number of different things. In New York, DOB, Department of Buildings, is infamous for prolonging processes, and having all this red tape and bureaucracy. So I think for us, a lot of our investors today are attracted to be able to hit, double-digit returns with monthly distributions directly deposited into their account without having to pick up a hammer, without having to attend to tenant calls in the middle of the night, which sometimes, we had to, and we still do because we do own properties throughout New York. So it's a very time-consuming thing when having to own real estate. So in our viewpoint today, being a lender is a lot more beneficial than being a landlord,
Sure.
for a number of reasons. But also, when you invest into a debt fund like ours, there's a number of benefits from it, right? One, you're hitting diversification. Your money is never put into one specific deal. It's put into a number of different deals, number of different asset classes, and a number of different locations with a number of different borrowers. So, that diversification is something that many of our borrowers are attracted to, along with the monthly cash flows with double-digit returns.
Man, that's awesome. One of the things I love to educate people on is alternative investments. And this sounds like a killer opportunity from alternative investments, especially if you don't like the volatility of your mainstream investment, the stock market, which unfortunately there's not a lot of financial education on how to do other things besides that. So, man, I'm super happy for you guys. It sounds like you're in a good position to help out a lot of people, not only lending to people and giving them the opportunity to change their lives, but then having this debt fund and giving people the opportunity to invest in there and get really consistent returns. Great things that you guys have accomplished. That's
Appreciate it.
awesome. Yeah,
Thank you so
absolutely.
much, Stephen.
Um, Ruben, if somebody wants to get a hold of you, work with you, either side of this investment life cycle you have, what's the best way for them to do that?
Shoot me a text or email, right? My email address is ruben@welendllc.com. My direct cell phone number is 917-815-1222. They could also visit us on our website, www.welendllc.com. And we're also on all major social media platforms, including TikTok. Not sure for how long, but we're on it. And that our handle is on all the social media platforms is We Lend LLC.
Awesome. Ruben, thanks so much, man. Any closing thoughts you want to share with the listeners?
Look, I appreciate you putting this together, Stephen. It's a pleasure to be here, and I can't wait to be on your next podcast whenever you extend another invitation.
Absolutely, Ruben. Thanks so much, man. I'm your host, Stephen Lee Thomas, and I'll see you guys in the next episode.
Thanks for tuning in to the Stephen Lee Thomas Show today. And if you found value in today's episode, then I have a favor to ask you. Please share it with friends, family, and anyone who might benefit from the insights we shared today. Also, don't forget to subscribe and leave a review if you enjoyed the show. And if you aren't already part of our school community, then head on over to school.com/multifamily mastery hub and join today. And again, thanks for tuning in, and I look forward to connecting with you in our school community.